With no boost from the bond market, equity investors, they're looking ahead to Netflix for the next upside catalyst. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. Happy Netflix Day.
Happy Netflix Day. What are we going to get this?
I don't know.
Oh, okay.
I think they're going to add subscribers and there'll be some ad revenue and stuff like that. No, I know nothing. I do know that the S&P is down 0.3% around the lows of the session, but in part now it makes sense with other asset classes. Earlier in the day, it really didn't. I just want to highlight the stocks. The semi index down by about 1.7%. This is despite the fact that TSMC had a pretty reassuring quarter, which was helpful after ASML did not yesterday. But nonetheless, the breakdown in the chip stocks continue as they're now definitely in correction territory. Gold at one point, record high, yields higher. That was confusing to me, Romaine, because we had high equities, high gold, and high yields. And I was like, something's not right here. And then equities finally start to roll over.
Yeah, absolutely. We're going to keep an eye on that. And of course, we push ahead to Netflix. A big day for earnings with Netflix taking us into the next phase of this earnings season with a big focus on big tech. And it really couldn't come at a more critical time. You saw the numbers on the board, and that's after the awful start that we had for stocks this second quarter. Barclays strategists led by Emmanuel Ku actually saying that corporate earnings are really going to need to do some heavy lifting to drive a rally any further than where it's gone already. A decline in analyst earnings estimates does offer some room for beats, particularly given that the recent sell-off has blown off some of the froth in this market. That's a good thing. We're going to have full coverage of Netflix earnings after the bell. Remember, in 5 of the past 8 earnings, the company's stock price moved more after the announcement than implied by the options market. That market right now pricing in about a 9% move up or down, depending on what we get in just about an hour's time. Now, while Ku keeps his eyes on equities, Kristalina Gorviega over at the International Monetary Fund is keeping her eye on the U.S. She's warning that the global economy is closely watching interest rates and industrial policies in the world's biggest economy and the reserve currency as well, given the potential spillovers. Take a listen.
All eyes are on the United States. One, what is going to happen with inflation and interest rates? Two, how is the U.S. going to navigate this world of more intrusive government policies?
Meanwhile, the U.S. Treasury sell-off does continue with prices down, yields up, a reflirtation with 5% for the 2-year yield, the 10-year yield still perched around 4.6, and that is close enough to levels that risk triggering an even larger sell-off. At least that's the view of portfolio managers over at Vanguard, who say even a small move higher on the 10-year, past that critical 4.75 level, Alex, could lead to a potential tidal wave before selling.
Yeah, they call it danger zone, which just makes me think of Top Gun. But the same idea, right? Okay, you move really fast and then something could actually happen. This is a visualization of what Romaine was just talking about. It's a 10-year yield. This is that 4.75 line that Vanguard was talking about. We're now just over about 4.6. The idea is once you hit this level, you're going to have a lot of positioning shakeout and some changes, and then you get a spike to 5. Now, we haven't seen that spike to 5 since last year in October, and that was right before we hit the low in the equity market. But we're still around the highs of the equity market. Sure, we're maybe down about 3-4% from its record high, but nonetheless, we're in a very different spot than we were back in October. And the question is, do we get to 5, Romaine? I've been asking this, I feel like, for a couple weeks. Do we get to 5 before we get to 3 on the 10-year?
Yeah, add that to all the various parlor games in the market right now as everyone tries to suss out where we go next. As we kick you off to the close here on this Thursday afternoon, let's start things off with Kathy Jones, Chief Fixed Income Strategist over at Schwab Center for Financial Research. All right, Kathy, this is the parlor game right now. We're looking at 5% on a 2-year, 4.6 on a 10-year, and a lot of people talking about how we are near that danger zone, if you will, where that could actually, I guess, spark maybe an added sell-off.
Yeah, I think there's some positioning that could cause an acceleration of the sell-off if we take out those levels. But let's keep it in perspective here. We've already come up 40 or 50 basis points from the lows over the last couple of months. So if you're still positioning in such a way that you're worried about, a spike in yield, you're probably leaning a little too much in the wrong direction right now. So not that we see yields moving up longer term. We actually see them moving down longer term. But, to have a heavy short position or a long position right now with a close stop seems like a pretty risky proposition.
Well, that's what I'm curious about. How do you position around this? I mean, unless you're just one of these people who wants to swing for the fences and take a big bet, a big directional bet here, it almost seems like you're kind of describing sort of a neutral situation where I guess if you're invested now, you just stay the course and then see where things go.
Yeah, there's a couple of ways that you can play it now. If you're more of a trader, you're more tactical. You could do a barbell where you have the short end. It's already priced for a pretty aggressive Fed policy, 2 years at 5% or pretty close to 5%, implying very few rate cuts. And then you can move out the curve and barbell it and have some 10 years, some 7 years, something like that. And you kind of neutralize some of that risk if we get a big bear steepener or something like that. So I think there are ways you can do it. You could do a ladder, which is kind of a staple for most investors. Just try not to time the market and stay in it and clip the coupon.
You're so calm about it. I like that. Very measured, like, hey guys, just a perspective here. Does that change if we get like a hike or no cut at all? I mean, I feel like William said, like, we're not base casing a hike, but we could if we need it.
Yeah, we talk about a parlor game, right? Trying to guess what the Fed's going to do. So the Fed basically hasn't changed their position very much at all since last year. And yet the market's gone from pricing in 6 or 7 rate cuts to taking out any rate cuts and talking about a hike. I think if they push it back far enough, the market's going to assume the next move is a hike. And that's what we're starting to see people price in. I don't think we'll get a hike. I'm still penciling in a couple of rate cuts at the end of the year. We're still seeing all the leading indicators of inflation starting to come down a bit. Moderate growth. I looked at the Beige Book, and the ratio of slight to modest references to strong was 5 to 1. So it tells me the economy is, it's growing, it's healthy, but it's not at such a level that the Fed's going to hike.
How does that translate to, say, looking at the corporate credit market?
We've liked investment-grade corporates for quite a while. The spread is very low relative to Treasuries, so valuation's a bit stretched. On the other hand, we had record corporate profits. We have an economy that continues to grow. And those all-in yields at 5.5% or so are pretty attractive. So we think that that's a way, especially if you're going to barbell this market and extend duration, you can hang on to that 5.5% by being in longer duration corporate bonds without a huge amount of credit risk.
I want to get your thoughts, on some of the other moves in the cross-asset space and how that feeds in, if at all, into what we're seeing in Treasuries, particularly with kind of this re-strengthening of the dollar. The dollar had kind of been dormant for a while, but first sign of trouble, and you see where people flock to. How much is that going to factor into the yield picture, if at all?
Well, I watch the dollar and I watch the foreign exchange market as kind of a leading indicator of what market expectations are, because it's really the most sensitive. And what we've seen is the dollar strengthen as expectations are that the Fed's not going to ease as aggressively as what we thought when we came into the year. And now we're seeing some divergence where maybe the ECB and the Bank of England cut in June. And the Fed is staying steady. That's going to keep the dollar pretty strong. And for the bond market, that's actually a good thing. It's less inflation, and it draws in assets.
All right, Kathy, always great to catch up with you. Kathy Jones, Chief Fixed Income Strategist over at the Schwab Center for Financial Research, helping us kick you off to the close here on this Thursday afternoon. Coming up, a sit down with the head of BNY Mellon's global investment management business, Hanneke Smits, her outlook on the market and more.
Plus, Apple's Tim Cook looking to Indonesia as a new potential base for production. We're going to discuss the economic impact with the Indonesian finance minister.
And shares of 23andMe having their best day on record. This after comments from the CEO about potentially taking the company private. It's our stock of the hour. Stick with us. A lot to cover today on The Close on Bloomberg.
The IMF and World Bank spring meetings are underway in Washington, and a key topic is the strength of the dollar. Now, even Treasury Secretary Janet Yellen acknowledged concerns from Asian economies like Japan and South Korea. Indonesia's chief economic minister today urged state firms to avoid making huge dollar purchases due to the depreciating rupiah. I'm happy to welcome Sri Mulyani Indrawati, Indonesian finance minister. Minister, it's really good to get your perspective. how big a headache is the strong dollar for you right now?
Well, certainly the movement of the exchange rate, it will affect many of the Indonesian economy and financial. On the export side, of course, the revenue is going to be much better because they are going to receive a local currency. But we also, in this case, dependent on some import, and that will then translate it into higher rupiah to the dollar, and imported inflation, it can also affect the inflation in Indonesia. So we have to be very careful at this very moment, especially because of the movement coming from the policy, coming from the advanced country, especially United States. Then the emerging country have to be very, very vigilant with this development. But what we've already done since the ASEAN financial crisis, global financial crisis, a lot of exercise has been done in order to improve the efficiency of the financial sector and the
Oh, it looks like we might have lost.
thing. So on the economic point of view, we are actually having a very good structure and resilient.
To that point, what else can you do? Because the speed of upside for the dollar, as well as the absolute level, is quite intense. What are some of the tools at your disposal to help the strong dollar, to help the sovereign and fiscal market also?
Well, we have to make sure that the macro stability will continue to be maintained. And in this case, on the monetary and fiscal side, we work very closely with Governor Perry in order for us to be able to adjust the macro stand in order to adapt with this new level of pressure. In this case, for the central bank, they definitely have their interest rate, policy rate, and in terms of responding the current situation. For us, in the fiscal side, we have to make sure that the budget can play an effective and credible shock absorber. On the one hand, we have to make sure that the deficit is going to be within or below the 3%. This is what the Indonesia fiscal prudence, which is going to be continued to be implemented. On the other hand, we have to make sure and be more selective in actually expenditure side and making sure that the revenue that will also increase due to this strong dollar, because some of our revenue is actually in a forex denomination, that can also be used in the most optimal way. So a combination of monetary fiscal in order for us to be able to maintain the macro stability and prudence will be very important. On the corporate side, I think they need to be really look at how their exposure to the forex, and many of them is already playing, or in this case, doing the hedging policy at the corporate level. I think Indonesia will be continue resilient in this kind of situation, but yes, need to be very vigilant.
So, Minister, when it comes to economic growth and some of the policies that have been implemented already under Widodo, and of course, some of the new policies that will probably be implemented when the new president takes over in October here, the growth targets that most foreign investors have set is still around that 5% mark. Is that still achievable?
Well, we are very confident given the resiliency of the economy during previous shock, post-pandemic in this case, high commodity price, now the higher for longer with the interest rate and inflation globally. I think Indonesia still maintain a 5% growth and supported by strong export as well as current account surplus. This need to be maintained, and I think within the new government, this kind of policy will be continue implemented. First, strengthening the structure of the economy, including continue progressing on a downstreaming industry so that the value added and competitiveness is going to be creating a much more buffer for the Indonesia. Second one, the macro prudence, in this case, both on the monetary, central bank independent and focus on stability, and fiscal policy that is adjusting to many structural issues, but at the same time maintaining a prudent principle is going to be very important.
Under your watch, under Widodo's watch, you've done a lot to increase foreign investment, particularly in the manufacturing sector. Just this week, we heard from Tim Cook. He was visiting there in Bali in Indonesia, making the case that maybe, potentially, Apple would be willing to set up manufacturing operations there. How far along are you in those discussions with Apple, if at all?
Well, we've actually very consistent in reforming the investment climate in Indonesia. We have passing a very difficult omnibus law to improve the investment climate and to simplify many of the business process. That's become one of the very important fundamental for us to attract policy reform, regulatory reform. On the other hand, we also, in this case, have many potential in our economy. You have a downstream industry of strategic mineral, the electric vehicle, battery industry. Indonesia have a lot of natural resource which fit with this kind of trend. And then, in this case, our ability to continue improve our investment climate with the bigger and very potential market will attract more investors, including Apple in this case. There are some discussion is already being made, and we do hope that it can be translated into the FDI.
All right, Minister, appreciate you taking time to be with us today. The Indonesian Finance Minister down at the IMF meetings in Washington, Sri Mulyani Indrawati. And Alex, I think it's kind of interesting, too, how much competition there is right now among some of these Asian nations that aren't named China, really buying for some of these big manufacturing contracts, whether it's from Apple or some of the other companies.
Open for business. That is
business.
definitely it, open for business.
All right, when we come back after the break here, it is showtime for Netflix and showtime for big tech earnings, a preview of what to expect from those results, which are coming up after the bell. Stick with us. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Match Group. Morgan Stanley downgrading the company to equal weight. This amid concerns about slowness in online dating user growth. Now, the analyst Nathan Feather says that Tinder, which makes up about 58% of Match Group's revenue, also lacks innovative ways to boost activity for its free users. He says this is a solvable problem, but a meticulous one as well. The shares moving fractionally on the day. Next up, let's take a look at eBay. A double upgrade today to overweight from underweight over at Morgan Stanley, with the firm saying eBay is best positioned to capture upside from generative AI. He cites maybe the extent here that some of those seller-focused algorithms dish out faster and higher quality listings. The share is moving higher by about 1% here on the day. And finally, let's take a look at JetBlue. An upgrade to neutral over at JP Morgan, a price target set at $7 a share. This after it had previously been withdrawn. The analyst Jamie Baker says the stock is well positioned for an upside move, and that's based on improving market sentiment. While JetBlue's margins do still trail those of the big three airlines, Baker says there are factors that could yield more turnaround momentum, at least in the domestic airline space. Those shares having a decent day, up about 4%, and those are some of our top calls. All right, let's pivot now to, well, what is going to be the marquee event later tonight. Netflix set to report earnings after the bell tonight. Analysts covering the stock do have high expectations for performance in the most recent quarter, and the shares, they've been on a tear for the past few months. Our next guest has a $660 price target, which is a bit above the average there. Jason Bazinet joining us right now, internet and media analyst over at Citi. He has a neutral rating on the shares. All right, Jason, seemed like last year Netflix was really trying to steer us away from paying attention to membership growth. And then, of course, last earnings report, that was the only number anyone cared about because they blew it out of the water. Is that going to be the focus once again tonight?
Yeah, Romaine, that's all anyone cares about is net ads, net ads, net ads. You're right. Management doesn't want people to focus on that number, but it's all the street cares about.
Are they going to focus also on the profitability? Has that improved?
Well, profitability has been great. Free cash flow has been great. I would say the bulls are very focused on the 2025 GAAP earnings number to underpin their valuation. The bulls would talk about 25 times earnings on $25 of GAAP EPS. To get to the 625, and that's why the stock is sort of plateaued at this level. And now what the street's looking for is either evidence that bogey that the buy side has moves higher or not, and that's going to be underpinned by the net ads.
In terms of the net ads, where do we want to see the net ads grow the most? We've seen EMEA really be that growth driver. Is that good enough? Does it need to be more broad-based?
Yeah, I haven't really picked up much anxiety or focus on the geographic source of the growth, where the buy side is much more focused, is trying to unpack what is actually driving the growth. Because we've seen a huge acceleration in net adds, but you've got a lot of moving parts, right? The competitors are marketing less. You've got the password sharing crackdown. And of course, you have the ad tier. And so all of the buy side focuses on really what is driving the strength, because that will inform how durable it actually is.
Do you feel like the street is under or overestimating Netflix's momentum here?
Sell side estimates for net adds are too low, both for this quarter and for the year, and even for next year. What the buy side is very nervous about, though, is there's a belief that the benefit that they're getting right now over the last 2 quarters from the password sharing crackdown probably only has 2 more quarters to go. So what the buy side is going to be listening for is there some sort of qualitative handoff that the company will signal where the net adds don't come from password sharing but can move over to the ad tier, which should have many years of growth, but it has to really pick up steam. I would say the ad tier so far has been disappointing in the contribution to net adds, even though aggregate net adds have been good.
Of course, as we talk about subscriber growth, Jason, sort of the core of that, which sort of drives that growth, is content. They've made some big changes here, a new head of their films division, a reorganization of that division, and of course a big push into live sports as well as video gaming. How much of that can be a factor over the next few quarters?
Well, the gaming stuff isn't really a big focus, and I would say the street's not really focused on the reorg. I think where the street is more focused is what's actually going to happen to the aggregate content spending. If you looked at sell-side numbers, 17 billion is the number for this year. Sell-side numbers have that going up $1.5 billion a year. If you talk to the bulls, they're asking questions like, why can't content spending just stay flat at 17 billion? And then have the business kick out more free cash? I don't think that's going to happen, but that's what the buy side's going to be listening for tonight. Any sort of commentary that content spend in aggregate can moderate or stay flat.
Jason, thanks a lot. We really appreciate it. It's going to be a fun hour and a half. All right, Jason Bazzani over at Citi, thank you very much. So I'm looking at the pricing in the U.S. So you got standard with ads, about $7 a month. Standard is 16, and then the premium is just 23. I guess the point is it's going to be really hard to want to pay money for ads.
Yeah, and the other thing is, too, I mean, you say just 23, but I was looking at it. I mean, Netflix is actually the most expensive of the streaming services.
23 is quite a lot.
Yeah, so I mean, remember, it used to be kind of the bargain, right? At least relative to what you were paying for cable. But now with all the other streaming services here, they're actually priced at a premium.
Yeah.
Yeah.
I guess.
Do you watch a lot of Netflix?
Do I watch a lot of Netflix?
Yeah.
It goes in waves. When Love is Blind comes out, I tend to watch it a lot.
Yeah. Is Love Actually Blind?
I do love me actually blind. Sometimes it depends. It's the whole thing.
I mean, I watched that, but I just didn't
dramatic.
get it. I thought that no one's blind.
I mean, coming up, we're going to talk about the investing climate with Hanneke Smits, a global head of investment management at BNY Mellon. This is The Close on Bloomberg.
Just about 3:30 p.m. here in a very cloudy and cold New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele, and see you later. I go on vacation starting
Have you been
tomorrow
outside
morning.
lately?
I have. It's freezing. I had to go to a panel. I was not a fan.
Okay, well, I hear you're going somewhere warm.
83-degree weather
But before
tomorrow,
you
man.
get there, you know, you got to talk about the markets, Alex Steele.
Do I?
You do.
Okay,
Yeah.
fine. They're doing something.
Okay, they're doing something.
Yields are higher. Yields are higher. Gold's at a record.
Yeah.
Stocks are finding direction. I can't find a stock narrative right now.
Yeah, stock's still looking for direction. Maybe that changes a little bit later tonight as we start to get some of the bigger tech earnings, if you will. Netflix on tap for after the bell. Meanwhile, a lot of concerns and, quite frankly, a lot of discussion here about the future of the investment industry, an industry that has been buffeted over the past couple of years, first by those declines in stock and bond markets in 2022, and then again by investors who grew skittish in 2023 over higher interest rates. But now that the dust is settling this year, big asset managers are finding that size and scale does matter. Our next guest oversees 7 affiliate investment firms, including Dreyfus for short duration strategies, Inside Investment for broader global fixed income, Mellon for index management, and Newton for multi-asset and active equity strategies, all under the umbrella of BNY Mellon's investment management business. Pleased to say that Hanneke Smits joins us right now. She is the global head of that business with $2 trillion in assets under watch. Hanneke, great to have you here on the program.
It's great to be back, Romaine.
A lot has been going on for anyone in the business, whether you're managing money or whether you're a client trying to keep tabs on your money here. Now that I guess the interest rate picture has stabilized, it may change, but it's stabilized. Some of the issues we dealt with in 2022 are behind us. But what are clients asking you right now? Are they still looking for meaningful changes to their portfolios, or are they willing to just take it as it comes right now?
So we're seeing a bunch of different things, right? So when you compare it to your point, to what we saw in 2023, we saw clients in risk-off territory. We saw a lot of clients switching into cash, and we saw them mostly moving into passive fixed income. What we started to see towards the back end of Q4, which also persisted in Q1, both in the industry as well as in our own investment management business at BNY, we saw an increase in fixed income, actually also in LDI strategies, and also increased demand for active equity strategies. Again, when I look at our investment firms, Walter Scott and Newton, they have very specific strategies in high conviction, growth equity, and income in particular. There's been more interest in that than we saw 12 months ago. But in particularly, very strong demand for LDI and active fixed. And that was really driving the positive flows that we've just announced as part of our first quarter earnings.
What about private investments, private capital investments?
Yeah, so we continue to see demand for privates as well. We're, of course, not alone in that. And to that extent, we have been considering how we approach that part of the market. As you know, we're quite strong in traditional active and indexing and cash. And we just announced a partnership with CIFC a couple of weeks ago, which is a US-based middle market lender, already a client of the broader enterprise in asset servicing and issuer services. And from an investment management perspective, we're opening our distribution platform to CIFC to help them raise money from EMEA and APAC clients. And that is something, when we talk about clients, it's also really important to investment management clients. We're seeing clients moving towards doing business with fewer and trusted and scaled providers. And therefore, we need to consider how we go to those clients, both with sort of in-house manufactured products and then also products from third parties.
What are you hearing about, say, wanting to have liquid strategies versus money tied up in private capital?
So that is always a conversation with clients.
Is it different now in any way?
It is, well, it depends on where you are, right? So if you're, say, in the US institutional market that have quite a long history of investing in private markets, they are quite well allocated to private market strategies. But that is not necessarily the case for pockets in Europe and APAC, and it's also not necessarily the case for a number of our intermediary clients and for the wealth segment. So it really depends on the channel and the exposure that they've had, and therefore the trade-offs that they need to make between liquidity and locking up money for longer.
Does having, what is it, $6.6 trillion in money market funds at this point? So there's a ton of money on the sidelines, and I can't quite tell if that's like a good or bad thing for a business like yours. Is in like that money's going to come into all the different strategies and allocate, or do you feel like that money is sticky where it is right now?
Well, this is then also a question about rates, right? And where rates are going to go. And we had started to see with the expectation that rates were going to get lower earlier than perhaps what we're seeing now. We had seen clients starting to shift out of some of those money market funds, but it's not consistent. In our own money market funds, we've had very good performance, so we've seen good inflows. But when you talk about that money waiting on the sideline, I do think it's waiting for duration and start adding duration to the portfolio as well as some equity components. This is why we also work with clients on asset allocation. We've developed a number of tools that we believe are relatively unique, and it really help clients understand some of those trade-offs that they make between liquid assets, traditional active and illiquid assets.
You mentioned some of those flows coming in. Is that being taken? Is that share being taken from some of your competitors? Where's that money actually coming from?
So some is from some of our competitors, and some of it comes on the back of very good performance, and some of it comes from our own clients who are shifting strategies.
So how do you sustain this, Hanneke? I mean, we talk about this idea of how we're in some sort of inflection point, whether it's for the economy or monetary policy or what. You have a company like yours, or at least your umbrella company with BNY Mellon, which has been around for 240 years this year, I believe. I mean, how do you sort of transition to whatever the next phase is going to be without really knowing for sure what that phase is going to be?
Yeah, so this is, I wish we had a crystal ball, right? We're, of course, in the business of making sure we're prepared for all eventualities. That's true for the bank, and that's true for us in investment management. In investment management, we're relatively young. Most of our firms are sort of celebrating 4 or 5 decades of being in business. So in the context of 240 years of BNY Mellon, we're still sort of in the toddler stage, if you will. But 240 years is really quite something, right? When you think back to that. As an investor, the way I think about it is we were one of the first companies also to be included in the S&P 500, and we're actually still in the S&P 500, right? Alongside another 53 that were included in the S&P 500 in 1957. And what I think that really speaks to, which is a culture that we're also having in investment management, is the quality of both being resilient and providing safety and soundness, but also innovation. You got to innovate. So we're doing that in investment management as well.
Right.
We are delivering more products, and we're also delivering more solutions to our clients.
We only have time for one more question. I have to ask you, you're in town for the 30% Club events here, which seeks to increase board representation, particularly with women. Give us some update here on how much progress that initiative has made.
So first of all, we've made a ton of progress, actually also in no small way thanks to actually Bloomberg. We had your very own Peter Grauer in our offices yesterday at BNY Mellon, where we were celebrating the launch of a cross-company mentoring program that is now in its 8th year. We had about 250 participants joining us, and these cross-company mentoring programs have been really instrumental in helping women advance up the ladder in their own organization. When we look at progress, we now see on boards that we have 33% of the roles on boards are held by women, from 21% when Peter assumed to chair all of the US chapter. And we're also starting to see actually an increase in women taking up CEO roles, because really the next battleground is in the C-suite, right? Women holding P&L owning type roles, and that's really critical.
Well, you're certainly doing your
But we
part.
still got a lot of work to do.
Absolutely, and you're doing your part to help get us there and push us along. Gonna have to leave it there. Hanneke, great to have you. Hanneke Smits, Global Head of Investment Management at BNY Mellon, and as she pointed out, Peter Grauer, who helps lead the 30% Club, is also, of course, the chairman of the parent company of the network that you're watching right now. All right, coming up, our stock of the hour is 23andMe. Stick around. We'll be back in a moment. This is The Close on Bloomberg. All right, it's time now for our stock of the hour, and we're taking a look at 23andMe, the company behind those DNA tests. The stock price had plunged. Yesterday, it had actually closed out at about 36 cents a share. Today, rallying about 40% up to 50 cents a share. This after the CEO floated the idea of taking the struggling company public less than 3 years after going public by way of SPAC. Abigail Doolittle is here with more. Normally, you don't cover penny stocks, but of course, this has been a stock that has really fascinated a lot of people, particularly with who the CEO is, and of course, the fact that those tests for a while were just ubiquitous.
Yeah, you know, where have they gone?
Yeah.
I guess people who want to do them, find out what their ancestry was, they have done them through 23andMe or Ancestry.com. But she is pretty interesting. CEO Anne Wojcicki, of course, she had been married to Sergey Brin of Google, and they have a couple of children together, but she's impressive in her own right. Yale University, biology. In any case, in 2006, she formed this company with 2 other people. So I would say it's a real labor for love, because what the announcement is today is that on April 13th, she told the board that she wants to take it private. She's going to stay in control, and she's not looking at any other options. So it's not like she's trying to cash out. She's really just trying to stem what's going on there for the company. The rigors of public, a public company is so much more than a small company. I think a private company. I think that that's what she has certainly
And it's fascinating, too, because, I mean, they're not the first. I mean, how many times have we talked on this show about a company that basically went public, usually through a SPAC or some other kind of backdoor way, now basically saying, well, maybe we shouldn't have done that.
Yeah, well, we were just a couple weeks ago talking about Endeavor, so a media company. So yes, it does happen. I would say in this case, I think she told us at a conference in February that they were looking for alternatives. She's thinking about breaking the different portions of the business apart, but really trying to keep this thing going. The interesting thing is the numbers are okay, not tremendous growth, but relative to, I'm trying to find where my numbers are here, but in any case,
they're good numbers. I trust you.
The profit's gotten a lot smaller, or the loss for the profit has gotten a lot smaller, and revenue is basically steady. It's actually up a little bit. So I think, again, she's just trying to turn the tide here. And you have to imagine, it does say she's working with advisors. She probably has access to the very best people in the world. So stay tuned.
All right, definitely staying tuned. Apparently, it's a new product, Total Health.
Yes.
It's over a $1,000 program that includes blood tests, regular check-ins with company healthcare providers, in addition to DNA testing.
Okay.
So look at that. So it's not just your DNA testing.
Yeah.
Which makes it a little different than Ancestry.
What does all this tell me, though?
Well, how curious are you about your lineage?
Not very curious.
Me neither. But my husband is, and he's all over it. But and what can I say?
You know, there's a period when you get to 1800s, 1700s for my people where you kind of just don't want to know what happened.
Which is fair enough. But then it's like, okay, then you don't want that. All right, Abigail, thanks a lot. Really appreciate Abigail Doolittle joining us. All right, coming up, we're going to count you down to the closing bells with Kristen Bitterly, Head of Investment Solutions over at Citigroup Global Markets. This is The Close on Bloomberg.
This is the countdown to the close. I'm Romaine Bostick alongside Alex Steele. And Alex, before we get to the broader market, some individual movers that we should get our viewers up to date on. Nordstrom shares at one point spiking about 13%. This on the back of a Wall Street Journal report that the Nordstrom family is weighing options to take the retailer private. We should point out that Reuters just about a month ago reported something similar. Bloomberg has also reported something similar as well. So if you believe all of these reports citing people familiar with the situation, Alex, maybe, just maybe, there's something to this.
Yep, clearly shareholders do like it. Looking at the overall index, though, I mean, we are pretty much now flat on the day. Also checking a look at NASDAQ 100, just down by 0.3%. I flagged that because, of course, Netflix being a large part of that. But two different areas I want to highlight. We were kind of alluding to this yesterday. The SOX index continues to roll over, the semis, right? So we're deeper into correction territory. We're very close to the 100-day moving average now, having just blown through the 50-day. On the flip side, you have an airline index, an ETF, basically, that has all the major airlines. We got United, and then we also got Alaska Air doing really well, too. I mean, a lot of these guys, granted, it's not Spirit or Frontier, but they're doing really well. What do we make of this, right? Airlines up, chips down.
Yeah, absolutely. Here, as the rotation continues, maybe that changes tonight. When we do get those Netflix earnings, those shares a little lower here as we head towards the close. A little bit earlier, we did have a chance to catch up with Kathy Jones over at Schwab. Take a listen to what she had to say about the sell-off in the Treasury market.
I think there's some positioning that could cause an acceleration of the sell-off if we take out those levels. But let's keep it in perspective here. We've already come up 40 or 50 basis points from the lows over the last couple of months. So if you're still positioning in such a way that you're worried about, a spike in yield, you're probably leaning a little too much in the wrong direction right now.
All right, Kathy Jones kicked us off to those closing bells just about an hour ago. And here to help take us to those bells is Kristen Bitterly, Head of Investment Solutions over at Citigroup Global Markets. The price action over the last couple of weeks has been a little discouraging, particularly coming off of that blockbuster first quarter that we saw for equity markets here. Do you think, though, that this is just kind of an adjustment, or are we really going to see a complete shift in the momentum in the market?
I think it's just an adjustment. I mean, when we're coming off a quarter where you saw double-digit gains within the S&P 500, Q4 of last year, you also saw those double-digit gains. So we have 2 quarters back-to-back. I think it's everyone just kind of taking a pause, a breath. Obviously, there is the conversation both about geopolitics as well as the Fed potentially delaying rate cuts. So that's weighing on markets. But when we look at earnings and the fundamental story actually looks pretty good. That we could see by the end of this year that all sectors are actually in the green. You have 5 sectors anticipating delivering in excess of 10% earnings growth. So if that fundamental story is there, we could see continued support.
So you think that fundamental story will be broader? It's not just going to be whatever, tech and energy like it was the last couple of quarters.
I think so.
Yeah.
And I think there's some surprises in there. I know this has been a conversation that has been really frequent about, look at like utilities anticipated to deliver, earnings growth in excess of 20% on the back of the AI story, energy, given what's happened with the price of oil. And so there's some positive surprises in there as well.
Yeah.
Obviously, if the Fed holds rates higher for longer, that's going to put continued pressure on small caps, on, balance sheets that aren't healthy. But for the broader U.S. equity market story, I think it's compelling.
You mentioned utilities and energy that maybe have their own story, but what would be the inflation catch-up assets that you want to play the higher for longer scenario?
So I think you have to look at just strong balance sheets in general. So the high dividend paying stocks, those were ones that were out of favor in terms of the Magnificent Seven last year. So I think that's an area that could see continued inflows if we are in this higher rate for longer. Anything related to quality balance sheets, we're playing it in a very generic sense in looking at the equal weight S&P 500. Because when you look at the valuations there, you're looking at about 16 times forward earnings, as opposed to some of the areas that look stretched. Healthcare, some of the subsectors, healthcare equipment is an area that's particularly interesting from a valuation perspective, as well as one that could withstand some of these pressures as well.
The equity risk premium, though, is really low. Why not just own bonds?
Well, we do own bonds within our portfolio, so I love that question. But in terms of being very balanced, I think the bond story is one where if you're buying bonds for the absolute yields, yes, there could be continued volatility in rates. It seems that we're consistently repricing how many cuts we're going to get. But bonds are attractive when you look at investment grades, when you look at preferreds. I've talked about this frequently, even munis, the kind of seasonality that we tend to see with tax payments last week, or I guess earlier this week, that were due. So I think there's an attractive portion within the portfolio going up in quality and capturing the absolute yields, even though you could see some volatility.
Coming into this year, a lot of people were talking about investment opportunities outside the U.S. In fact, it seemed like for a couple of months at the start of the year, people were actually saying it was better to be outside the U.S. I feel like that sentiment, or at least those people who are banging that drum, have kind of faded into the background.
Yeah, so when you look at how we've been allocated and investing, I think the U.S. story and U.S. dominance is going to continue, and there's plenty of opportunity with anyone who has, kind of home bias. And a lot of the trends that we're seeing in terms of flows, whether it's flight to safety or this broadening of the market, I do think there are some interesting areas when you look at broader Asia. So some of the markets that we've been adding exposure, India had an amazing year last year, and that's really a longer term story about demographics. You look at the average age, you look at the population, you look at the investment in entrepreneurship and technology. Yeah. So there are areas that merit exposure.
How easy, though, is it to make those investments in India, right? I mean, meaning for actual investors, because anytime I hear people say that, I always think, well, how do I do that? I just can't go and buy an Indian stock, at least.
Yeah, you have to look to the ETF market. You have to look to the broader fund market in order of getting kind of
ETFs
broad. Exactly. That's a very simple way of doing it. And you are seeing the options expand. So it's something that I think when you look at the earnings growth that market has been able to deliver and the interest more broadly based on those longer term demographics and investment, we should see those types of options expand.
All right. And China, you're over China?
No, I wouldn't say over China. It's just it's tough right now in terms of when you look at the average exposure that, let's say, a U.S. investor would have to that market. It tends to be very small within their overall portfolio. But I do think, this is an area we're watching very closely. It's obviously going to be something that would determine the trajectory of oil. When you see some of those growth prints, manufacturing, the PMI measurements have turned positive and in an expansion territory. So keeping a close eye.
All right, Kristen Bitterly, Head of Investment Solutions over at Citigroup Global Markets, helping us count you down to the closing bells. Just about 3 minutes to go. Alex, broader market still on the back foot. The sell-off in treasuries continue, though. A bit of a tamp down in the VIX and some flatness in the dollar.
All right, where's your countdown clock?
The countdown clock, of course, all eyes are going to be on Netflix. There are other earnings as well. I don't think anyone's going to care, but there are a few others. But of course, everyone is focused, not just because of what this could mean for Netflix, but whether it provides a bit of a catalyst for that broader tech trade, which has kind of just faltered over the last 2 weeks.
Exactly, and we get big tech, next week, right? If you can keep delivering the numbers, we got something going here.
Yeah, why isn't Netflix as part of the Magnificent Seven?
It should be, right?
Yeah, that should be. Definitely given its performance, options, markets pricing in a 9% move up or down. Stick with us. Full market coverage of what happened today. Full market coverage of those earnings. We'll take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. Here to help take us beyond the bell. It's a global simulcast. We're joined right now by Scarlett Fu in the television studio, Carol Massar and Tim Stenovic in our radio booth as we welcome our audiences across our multitude of Bloomberg platforms, including our partnership, Carol Massar, with YouTube.
Yeah, absolutely. Interesting day. Some volatility once again out of the gate. It felt like investors were trying to make some gains on the equity side of things, but that has once again kind of come undone. It feels like this is a pattern we continue to see, Tim.
Yeah, it is. Abigail Doolittle pointing that out on our air yesterday. The S&P 500 falling out just after the morning, down about 0.3% right now. But you know what? Who are we kidding, guys? It's all about Netflix. If it's setting the tone for the earnings season, I think when it comes to the consumer tech companies.
Absolutely. Netflix shares lower ahead of those results. In fact, you see tech as a group down by 0.9%. Among the Magnificent Seven, you've got Meta and Nvidia kind of bucking the declines.
Yeah, but are we priced for perfection or not? So Geetha Ranganathan over at Bloomberg Intelligence was saying that overall, the street is sort of underestimating the momentum that will really get here from Netflix.
Yeah, I mean, it still has an incredibly high PE, and I know a lot of people don't really care about PEs anymore, but some of the valuation metrics certainly look stretched. But again, is that a Netflix issue or is that really a broader market or at least broader tech issue as well? What else do you got, guys? I guess you're not going to pay attention to Western Alliance or Intuitive Surgical or PP Industrial. It's all going to be about Netflix. Let's get you through the numbers here in the broader market here as we wait for those numbers to cross. The Dow Jones Industrial Average basically about flat on the day. It is holding into the green, but it takes a while for these numbers to settle. Right now, it is up more than 20 points or about 0.1%. The S&P 500 lower by about 10 points or 0.2%. The NASDAQ Composite down about 0.5%, and the Russell 2000 closing out the day down about 0.2%. Netflix earnings, guys, crossing the wire right now. Your headline number coming across the screen for the first quarter, streaming paid net change, 9.3 million coming in, and that looks to be a very big beat. The street was looking for 4.84, so a beat on the additional subscribers added to the service in the most recent quarter. EPS coming in at 5.28, a beat. The street was looking for 4.52. Revenue coming in higher than expected as well, Carol Massar, as the street now getting an upside surprise.
Well, it's fascinating, some upside surprise when you look at that, add to subscribers. It's hard not to kind of be kind of blown away by it, more than about double, right? That or almost double that what the street was expecting. Having said that, you're looking at shares of Netflix getting beat up a little bit here in the aftermarket initially. It's down about 2.6%.
Do you guys think this has to do with the company? It's saying that they're no longer going to report quarterly membership numbers starting next year.
Maybe, but they also said that they do expect paid net additions to be lower in the second quarter than their first quarter on a sequential basis there due to, quote, typical seasonality. But I wonder also if that's a bit disappointing.
Well, I mean, just the fact that for the first quarter they had such a blowout number in terms of subscribers added, it's pretty huge. The subscribers added was 16%. That surpasses the 13% rate that they posted in the fourth quarter, which already was kind of a monster number.
Yeah, it's always hard to dig through these because they put everything out in like 3 separate releases here. But I think that forecast going forward is going to be critical. They're basically waving us off those quarterly membership numbers. But then when you look at the guidance that they're giving for the current quarter, the current second quarter that we're in, they are giving an EPS projection of $4.68, which would be lower than what they're reporting for the first quarter, and it would only be slightly higher than the $4.54 that the average of analyst estimates had on the clock.
It's just interesting to kind of watch what's been going on with the stock in the aftermarket. We're now up about 2%. Our Lucas Shaw putting out his story on it, saying Netflix posting its best start to the year since 2020, attracting more new customers than anyone expected thanks to a strong slate of original programs and a crackdown on that password sharing. It's something we've talked about. And he talked about attracting new customers all over the world, in particular in the U.S. and Canada. And that is something, though, our Geetha Ranganathan talked about. Keep in mind that this is a company that they, lots of content, smart content, but it's a lot of also non-English language content. And that is really important to the international subscriber base. 2/3 of subscribers are international.
Yeah, the company talking about this in the engagement section of the letter, calling out recent hits like Three Body Problem and including, can't say ratings, but including how many people were watching Romaine, 39.7 million views. Avatar, The Last Airbender, Love is Blind Season 6. They call it best in best-in-class reality TV.
Yeah, it is.
American Nightmare.
Yeah.
And then Stand Up with Dave Chappelle, The Dreamer, 18.4 million views. So some data that Netflix just started reporting, those viewer numbers.
I want to go back, though, to the international thing, because it's kind of interesting, too, here, particularly on the forecast. They are talking a lot here about headwinds in the currency exchange space, the FX rate space here. In fact, their forecast for growth for the second quarter is coming in at about 16% on a revenue basis, but when you strip out the effect of FX rates, growth would actually be 21%. They're blaming part of that on changes to devaluation of the local currency in Argentina. But they also make it clear that going forward for the full year, these FX swings are going to be a big factor. And they say they finally implemented, or they're going to launch, an FX risk management program to reduce some of that volatility.
Yeah, and I suppose that's good news for a company that's increasingly relying on growing outside the United States. One thing they point out in their release is that our share of TV viewing is less than 10% in every country. We know that for a long time, everyone's been saying the U.S. market is fairly saturated, but you go outside the U.S. market, and there's a lot of room for growth for a company like Netflix. And of course, it's kind of the envy of the streaming industry because they do this and they're profitable. No one else can say that yet.
Yeah, talking about that, let's talk about that free cash flow. So overall, their net cash in the first quarter was $2.2 billion. Their free cash flow was $2.1 billion. Yes, that was flat year on year, but $2.1 billion of free cash flow despite any content spend.
Can we talk for a second just how successful this password sharing crackdown has been for the company?
Have you felt it? Have you seen it? Have you experienced it?
I'm not here to talk about me, but I can say that, certainly members of my family have experienced this. But no question that, this was something that for years Netflix said didn't actually bother them. They liked the growth of the way that people were sharing passwords. They liked the fact that people were watching this, widespread. And now just by essentially clicking a button, changing the way that they're able to get so many more people to sign up. I mean, kind of makes me concerned about what other companies are going to do when it comes to this.
Well, speaking of sign up too, they talk about their ads membership growing 65% quarter on quarter after rising nearly 70% sequentially in each of the third quarter of 2023, Romain, and the third quarter of 2023. I mean, there's a lot going on, right, that Netflix has been doing to kind of change some of the financial dynamics in their favor, it seems.
Yeah, I am curious to see what they say on the call about content and content spend here. We were talking a little bit earlier with Jason Bazinet over at Citi. He actually thinks that content spend is going to go up a little bit from where it was last year. But remember, last year it basically dropped. I think it was kind of like the lowest levels we had seen going back to like 2017 or so here. So whether they need to like increase that in order to keep folks coming in onto the service.
Well, the idea here from the new film chief, Dan Lin, is that they're going to spend less on films. He reorganized the division. They're no longer going to spend for things like Red Notice and The Gray Man. He wants to make better, cheaper movies less frequently and develop their own material as opposed to wait passively for agents to bring over their best stuff.
But I think that's interesting, though, too, because, Lucas Shaw keeps that list of kind of like, the most watched Netflix programs and stuff like that. He makes his point. Like, everything that's most watched in there is just like old TV shows now.
Love is Blind? That's not old, dude.
Hey, there's nothing wrong with old, kiddo.
But you know what I mean. The point is that, like, it's not their original stuff. It's not even some of the more expensive stuff. It's like, old episodes of, I don't know, The Office or something else. And I wonder, like, whether that ends up being, because I feel like in the years past, that was kind of what made Netflix, because you can go binge watch that stuff, whether they move back to that.
Geetha said that is part of their assets. She talked about the breadth and depth of their content. She said licensing. She talked about Suits. And she said like Sex and the City that just came onto their platform. I got to say, I actually went back to start watching the old Sex and the City on their platform. So it's, definitely something that moves the needle for them.
It's an HBO show originally, though, and that's the thing. I mean, you have people out, going back and watching old episodes of something like Curb Your Enthusiasm, for example, which just is off the air now. But, you can see clearly when you go to HBO Max or go to Max that it's one of the top 10 shows right now because people are probably going back and watching those old episodes.
Yeah, how does that work? So it's an HBO show, but then it goes to Netflix, even though HBO has its own streaming thing. I mean, I feel like that's going to get pretty complicated pretty fast.
Yeah, so
money,
Netflix
right?
pays
Licensing?
HBO, I should say HBO pays Netflix to put it on there. Yeah, HBO gets money from Netflix, so they're looking for that cash, but at the same time, it kind of generates interest in the new season as well. So it's a virtual cycle.
And this has been a problem, though, for Netflix, too, because if HBO or one of these other companies decides they want to play hardball, then, of course, you can just pull that content, and then, all of a sudden, they don't have a lot of the hit shows.
They did it all right. They've
done it several times, yeah.
I'm just going to say with more than $2 billion with more than 2 people per household on average, they are noting in that shareholder letter that they've got an audience of over 500 million people. So kind of interesting, but again,
right
the stock.
Now?
What? Yes.
At this exact moment?
Yes. Watching this.
Maybe
watching
more,
this.
maybe less. Anyway, the stock is down 5% in the aftermarket. So I feel like the call is going to be really important and really interesting in terms of what analysts push. All right, guys, we got to go. We know you got to go. That's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals. We call it Beyond the Bell. We'll see you same time, same place tomorrow.
We're going to get back to Netflix earnings right here on Bloomberg Television in a second, but some breaking news on Nordstrom. A while ago, we talked about a report out of the Wall Street Journal that the company was considering options that go private. We are now learning directly from Nordstrom that the company has formed a committee after the family has raised take private interest. Basically, Eric and Pete Nordstrom have expressed interest in taking the company private, the company acknowledging that and saying that they have formed a special committee of independent directors in order to weigh the proposal by the Nordstrom family and to consider any other potential options or transactions. We're going to get you some more details on that, as well as a deeper dive into those Netflix earnings. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bosick. The S&P 500 still in the doldrums, down another day here, only fractionally 0.2%, holding the line around the 5,000 mark. But there was a lot of pain in this market. You saw that in the chip sector with the Philadelphia Semiconductor Index moving lower for the 6th time in the past 10 sessions. And more importantly, now in correction territory, down more than 13% from that all-time high that it had hit back in early March. Now, a lot of eyes right now are on the communications sector. That was actually one of the few bright spots here on the day, closing out the day up about 0.7%. Of course, one of the big movers in that space is Netflix. Didn't do much during the cash session. Scarlett, how's it doing in after-hours trading?
It's bouncing around in after-hours trade right now. Let's take a look. Down about 3.5% right now with the start of tech earnings season underway following Netflix's latest results. It added 9.33 million subscribers in the first quarter. That is almost double the consensus estimate. Now, sales and profit also beat analyst estimates. But going forward, Netflix says it's no longer going to release quarterly subscriber numbers. So it's going to change things up in terms of how it reports. But bottom line is, this is our top story this hour. And what the numbers show is that Netflix appears to be in its second major growth phase. Its crackdown on password sharing and a new ad-supported tier have yielded a big increase in new subscribers. Its first growth phase, of course, was back during the pandemic, which inflated its valuation. The stock back then was trading at about 53 times forward earnings. Since then, things have calmed down, and now Netflix has a 35 forward multiple. Romaine?
Yeah, absolutely. Here, we're going to take a deeper dive into those earnings in just 1 second. Some breaking news, though, on KB Home. The home builder announcing a new $1 billion share buyback authorization and boost, a 25% boost in the dividend. The share's up about 1.5% here in after-hours trading. But let's flip back to Netflix, which remains on the back foot here in after-hours trading. Bloomberg News reporter Lucas Shaw joining us right now from Los Angeles. And Lucas, you heard Scarlett go through some of the numbers on the surface. I would think that's looking pretty good here, but you see the share reaction. Square the circle for us.
You know, look, I'll be honest, your guess on this one is a little bit as good as mine. The numbers look great across the board. The two things I'd flag are, one, expectations for this company were really high. I mean, you saw a lot of analysts publishing optimistic notes leading up to it. The stock has been on a tear over the last few months. And so I think there was almost no way that it was going to live up to that. You know, you see the results. It basically doubled the subscriber estimates. That's pretty strong. So I'd say one is just expectations. And the other is maybe there was some sensitivity around the forecast. You know, the revenue forecast is actually pretty strong. It's going to grow faster than it did in the first quarter. Mm-hmm. But it said its subscriber growth would tick down a bit in the second quarter. That's normally what happens. But because of the lack of clarity on that number, you might see people being a little bit nervous around what that number is going to be going forward.
So, Lucas, when it comes to Netflix, it's driven by a couple of things. Certainly the password sharing crackdown that's yielded a lot of new subscribers, and this ad-supported subscription tier, which is lower price than the premium one, or the one that used to be the default. There's also this idea that it has must-see content. From where you sit, and I know that the second quarter tends to be seasonally less strong than the first quarter. What is it about the programming that's really locking people back in? Is it the movies that they're paying for, that they're paying up for, or is it the TV series that they're buying from, say, HBO Max or other production homes?
I mean, I'd say it's their original TV series for the most part. You know, you look at the first quarter, at least, one of the reasons they were able to add so much, they had a big new hit, like every couple weeks. From the start of the year, they had Berlin, which actually debuted at the end of 23, but is a big Spanish language original spin-off from Money Heist, also known as Casa de Papel. You know, they had Griselda with Sofia Vergara. They had The Last Airbender. They just had a really steady diet of popular shows across a lot of different genres and from a lot of different countries, and that's really the hallmark. It's sometimes hard to know with Netflix how much of that popularity is because it has a captive audience, it has that base, and how much is because the shows are good. But whatever it is, that alchemy is working right now.
All right, Lucas Shaw out in L.A., a closer look at what is helping and maybe in some cases ailing Netflix here. We continue our coverage of those earnings with Just Crossed the Wire with Daniel Morgan, Senior Portfolio Manager over at Synovus Trust. Dan, what was your first take?
Romaine, I was kind of blown away. You know, as Lucas was mentioning, coming into this report, you know, a week ago, the consensus estimate on new subs for this upcoming first quarter was about 4.1 million. Then it moved up to, you know, across the board about 4.8, 4.9 million. As Lucas was mentioning earlier, there were some analysts out there that came out with reports in the last couple of days that had estimates, you know, 5 to 6 million, which I wasn't quite sure where they're going to hit that number. But then they blew it out with this 9.3 million. So it was just really an unbelievable number. I was really kind of taken back by it, Romaine and Scarlett.
Yeah, I'm curious about the pricing strategy that Netflix is taking. Alex Steele was speaking a little bit earlier here about the highest price tier and whether that's actually helping growth or not, but also the idea of how Netflix's pricing sits relative to some of the other streaming services, which now, to a certain extent, almost seem like a relative bargain.
Yeah, I mean, I think the big thing, Romaine, coming this report, I mean, their average U.S., you know, standard membership is around $16. And, you know, you were talking earlier about some of these new initiatives that they have in practice with the password share where, you know, a group of people can still share a password at a higher price. And then you look at the ad tier models, I think they're around $6.99 a month, and then they're making up the rest of it with the actual advertisements. But you know, Romaine and Scarlett, I think they're pretty competitive. I mean, you look at Disney, you look at all the other big streamers that are out there. I couldn't say that Netflix was the highest priced of all of them. There are some lower priced ones, but they don't have the same content, the same series, and the same deck of movies. So I think you kind of get what you pay for when it comes to streaming.
What is your best guess for why the stock is trading lower in after-hours trading? I know that it's had quite a run-up so far this year, up about 25%, but over the past month, it's pretty much been kind of flat, and this was as analysts were raising their estimates on revenue and on EPS.
You know, Scarlett, it's got to be that release that you mentioned at the end of the call about not coming forthright with new sub information in future quarters. We know that Netflix trades on the sub data, right, on the new membership subscriptions. And the fact that they're not going to give us those guides, I think, is something that makes it that much more difficult to really look underneath the hood and kind of find out how they're driving, let's say, for example, this revenue and earnings beat. Because always in the past, Scarlett and Romaine, whenever I've been following Netflix forever, it's always been on that sub data that I look at. I don't even really listen. I mean, I hear the revenues and earnings, but I mean, I'm just zeroed in that total subscriber number, which they were, what, 269 million? The street was at 265. And then, of course, that huge beat. I didn't think they were going to do it. I thought the hurdle was going to be too high on that first quarter sub number, but they blew it out. So
okay, if they're no longer going to give that quarterly read out, what are they trying to signal to investors, to someone like you? Hey, we're not going to give you this detail, so we want you to pay attention to what instead?
You know, it's interesting, Scarlett. It's kind of similar to what Apple did when they no longer gave us iPhone unit volume. Do you remember that? Where we would get that number and we could charge, you know, average selling prices and get total revenue for iPhones. So now we're always guessing, based on what that revenue number is. So it's now going to become somewhat similar with Netflix, where they're going to give us a revenue and earnings number, and they'll give us little bits and pieces, and then we're going to have to kind of piece together, like, well, based on that, and the average price of membership is $15, what does that mean in terms of total new subs? So it just creates less information when we're craving for more information, right? And Apple did the same thing a couple years ago. And now we still come out with that iPhone unit volume estimate, right?
Yeah.
We're going to do the same thing with the sub data out of Netflix.
Perhaps the simplest explanation is the one that rings true. They're doing it, or they're not giving as much information because they can. Dan Morgan, thank you so much for joining us. Dan Morgan with this instant analysis on Netflix. Coming up, we're going to continue to take a deeper dive into how Netflix's advertising tier is paying off. Paul Verna, Vice President of Content at eMarketer, joins us next.
All right, back to Netflix. Those earnings crossing the wire just a little while ago. A beat on revenue, a beat on profitability, and a big beat in terms of the number of subscribers added in the quarter. 9.3 million streaming paid net changes here, well above street estimates and well above where it was just about a year ago. Paul Verna, Vice President of Content at eMarketer, joining us right now. Some people think, Paul, a lot of this was driven by the password crackdown rather than a bunch of people just deciding, I need Netflix in my life.
Absolutely. Yeah. I think the password crackdown has been a big factor. And I think the ad-supported tier as well, because it drives more subscribers at a lower cost of entry.
In terms of keeping these subscribers there, I mean, Netflix has always had a lot of churn, and we know they're not going to disclose these quarterly numbers anymore if you believe what they say here. But they have tried to pivot. We've seen them enter into live events. They got a big deal with WWE. They're obviously trying to do video games and basically things that are just beyond the normal scripted content that they were known for here. Is that going to be a winning formula for them?
I think that helps. I think another secret weapon that they have is how much content they produce in different countries, local content that resonates in those markets, but also resonates globally. Most of Netflix's competitors are very U.S.-centric when it comes to content production, not necessarily distribution, but actually creating the content, creating this content that's going to really, keep subscribers and gain new ones.
I was saying earlier that Netflix is the envy of the streaming industry because it's figured out how to do this and do this profitably and at scale. And this is something that the other guys, who are all legacy players, can't really match up with. What have we learned from Netflix's results that's applicable to those other streamers?
Well, I think you used the word scale, and that certainly is one of the ingredients. But it's true, Netflix has figured something out that all the legacy players are struggling with. And then you have the tech players who have so many other levers to pull, so they're really, in some ways, operating those businesses at a loss. But I think it does come down to the breadth of content, the early mover advantage, the success that they've had with shows that really have caught on across the whole world. And again, this looking outside the U.S. for subscribers to build those businesses.
And now with the advertising tier too, analysts are saying advertising could become 10% of total revenue by the end of 2025 and keep growing. I'm curious to get your take also on what the Hollywood strikes actually did to or for Netflix. 8 months out from those strikes, is there any evidence of any real lasting damage, or did Netflix come out of that as a winner?
Yeah, I think they came out of it quicker than some of the other players because they had a bigger pipeline. I think they were more prepared for it. They just had more shows in production or more shows ready to be resumed. And yeah, I mean, I think it's now basically a footnote in their past. I think some of us expected it to have more of a lasting effect, but I think they've pretty much jumped right over that.
Yeah, interesting too. I was just going back, just to go back to international, because I was looking at the 9 million subscribers, and it looks like the overwhelming majority of that was overseas here. Something like 6 to 7 million of that, and it was kind of evenly distributed through Europe and Middle East and Latin America, et cetera. So that's where the growth is, right? I mean, this is not a U.S. story in terms of the growth going forward. This is going to be an international story.
Yeah, and it has been for a long time.
Yeah.
You know, U.S., they have hit what's very close to a ceiling in terms of subscribers. But I think they have, you know, they saw that light many years ago, and they've been building those businesses.
Yeah.
And they have rolled out some of these new initiatives like the ad-supported tier in the UK, in Europe, in Latin America, Asia. So I think they've done a very good job of just broadening their horizons.
All right, Paul, great to have you here on a fast-paced day here with those Netflix earnings. Paul Verna over at eMarketer. All right, when we come back, we're going to use this as an opportunity to look back at a milestone day for Netflix 17 years ago today. And a question before we go to break, Scarlett. Netflix just reported that they are now up to 270 million paid subscribers. How many subscribers did they have back in 2007?
2007? God.
Yeah.
10 million? 15 million?
All right, well, we're going to find out the answer when we come back after the break. Stick with us. This is The Close on Bloomberg. All right, Netflix out with its latest quarterly earnings report, so fitting to look back at a major turning point for the company back in 2007. It was on this day back then when the company posted the highest first quarter profit in its thin 8-year history. Investors, they weren't impressed. Similar to today, the stock plunged more than 9%, largely because the report also showed Netflix had trouble attracting and retaining subscribers amid stiffer competition from Blockbuster. Yeah, Blockbuster. The brick-and-mortar rental chain was going all in on a Netflix killer called Total Access that let customers order DVDs by mail, but then return them to the physical stores. Now, obviously, we know who won that battle. The earnings report came just 3 months after Netflix had quietly debuted its Watch Now video-on-demand service, which let members view about 18 hours a month of movies over the internet. It was a prescient online pivot that would eventually run Blockbuster out of business and would eventually replace Netflix's own mail-order DVD service altogether. Remember Quickster? Yeah, no one does. But it wasn't the first time or the last investors would become unsettled about a competitive threat to the company. Investors bailed on the stock in 2003 when Walmart entered the online DVD business, but rushed back in a year later when Walmart abandoned the costly effort. Then there was the database corruption incident in 2007, the missteps in international expansion, the billions of dollars in cash burn to create fresh content after launching original programming in 2011. The groundswell of streaming competitors over the past 4 years from the likes of Disney and HBO also a factor. Then there was the writer strike, then the actor strike, and well, you get the idea. Through it all, Netflix has largely managed to get the last laugh. Today, it boasts about 270 million paid subscribers and rakes in more than $30 billion in revenue a year. That's a long way away from April 18, 2007, when it boasted just 7 million subscribers. You were close, Scarlett. There are still big challenges ahead, though. The Hollywood economic model remains broken. There is a slower adoption of connected TVs and consumer behavior tilting away from scripted content and more toward live events and video games. Now, Netflix has begun to invest in both. It just bought exclusive rights to World Wrestling Entertainment programs. It's dabbled with live comedy specials, and it plans to air a boxing match in July between Mike Tyson and YouTuber Jake Paul. As for video games, the company is churning out content from its own intellectual property, such as from Stranger Things and The Witcher, but it's also licensing popular titles like Grand Theft Auto. Now, Netflix has yet to disclose hard numbers on how many people play their games, but CFO Spencer Newman, speaking last month at a Morgan Stanley investment conference, cited at least 90 games added to the service over the past 2 years and as many as 90 more that are in development. He also said engagement for those titles, in his word, tripled last year as well. Scarlett?
Romaine, that is the perfect segue into our next guest. We're going to talk more about Netflix and its gaming strategy with Josh Chapman. Josh is managing partner at Convoy Ventures. Josh, you heard Romaine talk about how Netflix had first mover advantage when it comes to streaming. It doesn't have that first mover advantage when it comes to live sports events or video games. So from where you sit, what is Netflix's game strategy?
From my perspective, and thank you so much for having me, Netflix's game strategy is perfectly positioned for them given the library of IP that they have. And that is also mimicked by other IP holders like Disney. Just this last quarter, Disney invested $1.5 billion into Epic Games. You're going to see more IP holders like Netflix push their IP into the gaming audience for two reasons. One, this is additional revenue in a gaming entertainment industry that is incredibly lucrative. Gaming is almost a $200 billion industry. Movies and TV is about a $45 billion industry. So games are incredibly lucrative. And secondly, this is a way to increase retention within Netflix's apps and all of their applications across mobile and abroad. So this is a perfect fit for them, and we are very encouraged to see Netflix move into games.
So when a non-gaming company like Netflix jumps into the game space with both feet, what tends to happen? Does it make the pie get bigger, or does it just kind of steal a bit of market share?
It doesn't really do. It more makes the pie get bigger because further IP goes from pure movies and television to then being sort of put into games format. So it's just additive to the industry. What we've seen with over 3.3 billion gamers worldwide, this industry continues to grow and actually has secular growth through the last two economic cycles and in this one, whatever you want to call the current cycle that we're going through. Yeah. And so right now, Netflix moving into games, incredibly positive for Netflix and definitely positive for the gaming industry.
What is the state of the gaming industry right now, Josh, in terms of its size? And more importantly here, I mean, how big is that pie going forward that Netflix and, of course, the more traditional game makers are fighting over?
So the pie they're fighting over is about $200 billion in annual revenue. If you actually look at the market cap of gaming companies globally, it's about a $1 to $1.5 trillion market cap if you amalgamate all of it. So the industry trades at a great multiple on the revenue it's generating. I think what we've saw in this last quarter and sort of the state of the industry is that, one, venture funding is up. Secondly, Disney investing into Epic shows further reinforcement that IP holders are moving into gaming in force, $1.5 billion that they invested. And thirdly, public gaming stocks are actually all pretty depressed in the first quarter, which doesn't really make a lot of sense to me. Names like Roblox, Unity, EA, Nintendo, all these names are down about 20 to 40% in the last 8 weeks. The one exception to that is AppLovin, up 70%. So I think you're going to see gaming thrive, stocks probably recover, and a few of these look like buys.
It's interesting you bring up some of those investment numbers, the VC numbers, and I know Convoy has done a lot of work here in tracking that data here. Is there a risk, though, of a little bit of oversaturation here? I mean, I know that we're all gamers, and to a certain extent, or at least most of us are, whether it's something like a Grand Theft Auto or just some, some mindless game you play on your phone while you're standing, on the subway platform. But when do we reach, if at all, the point where there are just too many players in this?
Right now, we're adding 100 million players a year to the gaming industry. So as population grows, so does the gaming industry. So I don't think we hit a saturation moment. People thought gaming was over in the 80s. They thought the same thing in the early 2000s. They thought the same thing when mobile was kind of becoming quite saturated. But gaming continues to thrive, and as population growth increases and people become more connected to the global internet, especially in the emerging markets, you're going to see gaming continue to expand. And in the venture market, we saw almost $600 million go into gaming venture capital in Q1, which is up from Q4. So we've seen it stabilize to pre-COVID levels. So I think we've gone through the ZERP era, and then we've kind of come to a stabilized place now in venture funding.
Still, like Netflix, we know that the gaming industry has boomed during the pandemic. That was a big, big growth moment. But 4 years on, there's clearly some adjustment taking place. There's competition for user attention. I know that you've noted there were 10,500 layoffs across the industry last year, and there's more this year as well. So square that for me, where we talk about how the gaming industry is thriving, yet there are fewer employees working in it.
Gaming saw an incredible influx of funding. Over $14 billion were put into gaming in 2022 alone. And so what you're seeing now is essentially a reversion to the mean. As we're reverting to the mean, cost efficiencies and cost bases are right sizing to where the industry actually is, while revenue in the industry has continued to go up. So essentially we went way above mean and we're now back at mean. And I think this shows health in these gaming businesses. which is sort of an explanation where management teams are essentially like, we hired 1,000 more people than we needed. We need to right size by 500 of those people, get our cost basis in line. But at the same time, top line continues to go up. So we're going to be becoming a more EBITDA margin profitable business. And you're seeing a lot of management teams do that right now across tech more broadly, but certainly within gaming.
Absolutely. It's a familiar theme to all of us here who cover the fortunes of publicly traded companies. Josh, thank you so much. Josh Chapman is managing partner at Convoy Ventures.
Some quick breaking news here, Scarlett, outside the world of finance. This involving former President Donald Trump and the hush money trial now taking place here in New York City. We have learned that all 12 jurors have now been chosen for that trial. Of course, it's basically day 4 now. There was a lot of concern, Scarlett, about finding 12 people who could exhibit any sort of impartiality for such a high-profile case. But the Bloomberg headline is that they have chosen now the 12 jurors who will sit on this trial.
And I suspect those backup jurors better be ready to step up if something happens. And the ones who are chosen
might be a good bet.
can't fulfill their duty.
Yeah.
All right, let's take a look at how markets closed on the day. We're looking at 5 straight days of losses for the S&P 500. That is the longest losing streak since last October during the market's last stumble. And a big reason why is because of weakness in tech companies. The SMH, the ETF that tracks chip makers, down about 1.75%. TSMC, second biggest holding. We know what happened with TSMC and its results. And of course, a sell-off in treasuries. 2-year yield got within spitting distance of 5% once again. The latest data on jobless claims, Philly Fed, just reinforcing concern remain that rates will stay higher for longer.
And the big question is, what, if anything, can actually save this equity market? Scarlett, a lot of folks are looking for their Netflix to do that, but those shares in after-hours trading are down in the red.
This is The Close on Bloomberg. It is time now for the top 3, where we name drop the people driving some of the day's most talked about stories. And first up is Larry Fitzgerald. The former NFL wide receiver spoke with Alex Rodriguez and Bloomberg Originals chief correspondent Jason Kelly about how his football career gave him early opportunities, in business.
I think sports is really unique. There's not many businesses where, you go, to New York and, it'll be very difficult for, a financial advisor on the 5th floor to go upstairs and talk to Jamie Dimon and have a conversation with him. It would be difficult, but you can do that in sports. You can go talk to, Mark Lazary. You can go talk to, Mark Cuban, some of the most successful business people in the world. You have direct access to them. And so why you would not utilize those opportunities makes no sense to me.
It's just no good to be a pitchman anymore. Everyone wants to be a principal stakeholder. They want to own equity.
Yeah, well, good for them, man. Much better than the old deals that athletes used to get. And you can catch that full conversation on the latest episode of The Deal, which airs tonight at 9 p.m. on Bloomberg Originals, or Friday at 7 p.m. on Bloomberg TV. Scarlett, I'm keeping an eye on Quentin Tarantino. Remember him?
Yes, of course.
He hasn't made a movie in a few years. His last one was in 2019. He made this big proclamation some years ago. He's only going to make 10 movies, and then he was going to quit. So he was going to make another one here. It was something called The Movie Critic, but now we're learning he's abandoning that project. They hadn't started to film it yet. It was going to star Brad Pitt, but he's decided that it wasn't worthy of his 10th and final film, so he's going back to the drawing board. Didn't say exactly what that concept will be, but this particular film, at least according to him, is being shelved.
Okay, well, we'll see what happens. I feel like Uma Thurman's going to be part of whatever he does next.
I feel like if it's his final film, he's got to bring everybody, like Samuel Jackson, Uma Thurman,
John Travolta.
Robert De Niro still alive, right? Yeah, bring him back. The whole gang. How about that?
I would watch that.
Yeah.
I'd be into that.
Yeah, I don't know. Yeah.
Well, the last person I'm watching is Taylor Swift, the pop star.
Oh, he should put her in a movie. That would be bloody.
I think everyone wants her in a movie. She's going to release her 11th album tomorrow, but actually snippets of songs credited to the record are already being posted on social media.
Are they good?
I don't know. I haven't heard them yet. But, some people, of course, are claiming that these clips are fake. They're created by AI.
By AI. Okay, it's always AI's fault. Or maybe they're just trying to drum up hype. I mean, look, it doesn't matter. This album's going to sell a gazillion copies no matter what. And she'll go on tour, make $1 gazillion. The big question is, Scarlett, have you put in your pre-order for your vinyl copy of Taylor Swift?
I don't need a vinyl copy.
What do you listen to?
I'll go on Spotify.
Oh, okay.
To listen to Taylor's version.
Aren't you hip? But I assume you're going to be listening to this. You're taking off tomorrow for a listening party.
Yeah,
So,
absolutely.
yeah.
Yes.
Yeah.
Like I have to, celebrate it. Well, let's talk about Taylor Swift a little bit more because she is a cultural and economic phenomena unto herself. Her Eras concert tour materially boosted spending across the U.S. last year and is now doing so around the world. Joining us now is a professor at the University of Texas at Austin who teaches an undergraduate course called the Taylor Swift Songbook. Professor Liz Scala joins us now. Liz, thank you so much for speaking with us. What is it about Taylor Swift and her body of musical work that resonates with such a broad audience and justifies careful examination from someone like you?
Well, Taylor Swift is a fantastic songwriter. She's decorated, and songwriting shares a long history with poetic production. And so it was a very, simple way for me to engage students in poetic criticism by bringing Taylor Swift's music into the classroom.
You're an English professor who was introduced to Taylor Swift's music through your daughter during the pandemic. I'm curious because you started listening to her songs much more carefully around that time. How did the pandemic amplify the global interest in Taylor Swift?
Yes. I mean, my story is not very unique. I think that when everybody was stuck in the house and terrified and kind of imagining that the world might not go back to normal, that having Taylor Swift produce 2 albums was incredibly comforting. It was a form of therapy. It was very inventive on her part. And I think it really gave her a kind of multi-generational audience that she had not quite seen before. For me, it wasn't quite Folklore or Evermore that did it, but my daughter was listening to them, and it was just after that period when she began to, when she re-released Red, that I sat and really listened to her lyrics and thought that there was something very special there, and I could grab those freshmen and get them to pay attention to language in a way by using Taylor Swift's music in my class.
It's interesting when you talk about kind of the connection that she has and that her music specifically and those lyrics, particularly with a certain generation of folks. And as Taylor has aged, so too has her fan base, and they've come along with her. How does an artist like that, though, maintain that? When we're talking about Taylor Swift, I don't know, in 20 years, assuming she's still putting out recorded music, is that fan base going to be basically just a bunch of 50 and 60-year-olds, or is she going to be able to capture sort of a new generation of younger people that come along and find her?
All the evidence that I have seen suggests that Taylor Swift's audience is growing in dimensionality and in youthfulness. I guess every day. I was talking to a reporter this morning who was telling me about his 9-year-old daughter, who is a really big Swiftie and all excited about this album coming out tonight. And so I don't think that it in any way is her fan base restricted to people that are her age, or that it's gonna peter out anytime soon. I don't really see that happening at all.
We'd be remiss in not bringing up Professor. Of course, the title of this album, The Tortured Poets Society. Somehow you decided you would go down a path of, I don't know, studying medieval poetry, which I didn't know was actually a thing. Obviously, it's turned out well for you here. Is this, in all seriousness, though, is this concept here, is this kind of it? And I know we're kind of speculating here, but there are a lot of people thinking that the title of the album, what it's actually referencing, and the fact that Taylor herself, or at least her folks or people have said this is kind of her lifeline album, it almost sounds like they're kind of saying this might be it.
Yeah, well, that remains to be seen. Every time we think Taylor Swift has hit a certain height, she seems able to, go beyond it, right? So we thought that the Folklore album was this turn to indie music, this kind of rebirth of folk art, where she stopped talking about herself and her experience, and she was inventing character. And then it turned out she had Evermore, then she had Midnights. And now she has the Tortured Poets Department, which is kind of doing a lot of different work, I think, and maybe referencing a number of different things at the same time, which suggests to me a kind of literary value and a self-conscious literary value. She's thinking about the relationship of poetry and music. She thinks first about her songs lyrically, and I think it's kind of done for poetry what almost nothing else has been able to do in the last few decades.
All right. Well, from Chaucer to Taylor Swift, Professor, you've had a great career, and I think it shows you just how culture changes and why some of the things we think are frivolous end up becoming seminal and important. Professor Elizabeth Scalo over at the University of Texas of Austin. Stick with us. We're going to set you up for what to watch tomorrow. This is Bloomberg. All right, Bitcoin tried to rebound today as a lot of folks look ahead to what is known as the Bitcoin halvening. This is when the number of new tokens being produced is reduced by, well, half. David Pan joining us right now, a Bloomberg crypto reporter. When exactly does this halving actually start, David?
So the halving will actually start around 8 p.m. tonight. So we've been waiting for this ever since the last halving happened in 2020.
And how long does it last for? Because there's been so much anticipation ahead of this halving or happening, whatever you call it.
Yeah, so I mean, it doesn't take long for that to take place. The thing is, like, when the Bitcoin miners reach a certain a particular block on the blockchain, and then they would just trigger this adjustment in the code of Bitcoin.
So minutes.
Yeah. So maybe, yeah.
So what's the effect of this? I mean, most people seem to think that this will boost prices, but we've seen a pretty big sell-off in Bitcoin leading up to this.
Right. So a lot of people are saying, like, the event has been priced in, but we're not sure yet because, like, in the very long term, this event does reduce the supply of new Bitcoin. So that is the theory. Historically speaking, we've seen hikes in Bitcoin prices after the halving. So, maybe we'll see another bull run. We don't know.
All right. Yeah. So I guess more supply demand. We'll see how it shakes out. David Pan, Bloomberg crypto reporter, keeping an eye on the Bitcoin halving set to start later tonight. And you know what else is going to start later over the next 24 hours, Scarlett? The biggest election in the world that's taking place in India.
Yeah, almost 1 billion people are eligible to vote. But you know how long this whole thing is going to take?
Till June.
7 weeks.
Yeah, I saw that. They said this goes through June. I mean, I guess when you have that many people and more importantly, that many constituencies, certainly a reason why they need that amount of time. Also,
can you imagine if the U.S. election lasted 7 weeks?
Don't even start, Scarlett. That's a loaded question. All right, we're going to come back to the U.S. down in Washington. Those IMF and World Bank meetings taking place.
Yeah, absolutely. And finance ministers, central bank officials are all going to be gathering, talking through the global macro economy. We have heard from J.P. Morgan's president that it's possible the Fed doesn't even cut interest rates this year.
We're also going to get that Bitcoin halving, as we were just talking about. Well, of course, we'll bring you any news on that and how it affects prices. But we also get some earnings as well that we have to keep an eye on, Scarlett.
Yeah, I'm interested in American Express, certainly as a credit card issuer, and how it's seeing credit quality and demand from customers, and certainly what kind of fees it's still able to command for its premium cards.
We're going to get SLB as well here and PG&E, so we're starting to get into broadening out of the earnings reports, a broader look at the economy. And one other event is happening tomorrow, Scarlett. I guess we have to talk about it here. She's bigger than Jamie Dimon.
Oh, for sure. Taylor Swift releases her new album, The Tortured Poets Department. Big news for everyone.
Big news definitely for her and definitely for her pocketbook. Thank you for watching The Close. This is Bloomberg.